Hi, it's Sarah from Accountancy, and today we're going to take a look at how you pay yourself if you are the owner and director of a small UK limited company in 2023. So first of all, I'm going to caveat this by saying, look, everybody's situation is unique and personal to them, so please do take advice. Don't rely on what I'm saying here, because I'm going to have to make some really broad assumptions here in order to explain the numbers as easily as I possibly can. Assumptions are always dangerous, I know, but for the purposes of this example, I'm going to be making the assumption that you are the sole shareholder, director and employee of your business, that your business is making good, healthy profits, and that you don't have any other income from any other sources in the 2023-24 year. So with all of that in mind, there are a whole load of numbers that you need to understand. So before I get into the numbers and the detail and the tax consequences, we always recommend that most directors in this sort of position remunerate themselves by drawing a small-ish salary from their company and then taking the rest in dividends. So salaries are a tax-deductible expense. So salaries come through your P&L as an expense, and therefore they reduce the amount of corporation tax you would pay because they are deducted before tax is calculated on the profit. Dividends, on the other hand, are a return on your investment, basically a reward for the risk that you've taken and the growth that you have obtained for your company. But dividends can only be taken out of the distributable profit once the corporation tax has been paid. Now, you need to watch my other videos on corporation tax to understand about the different rates there. From April 2023, the main rate of corporation tax changed from 19% to 25%. All profits under £50,000 are taxed at 19% still, but if you go above £50,000, there are marginal rates until you hit profits of £250,000, at which point everything's taxed at 25%. But there's more detail in other videos there. So back to your remuneration as the director of a small limited company. So there are a number of thresholds you need to be aware of to understand why we suggest you remunerate yourself in this way. So the first one is something that's called the lower earnings limit, and that is currently set at 6,396 for the year. So that's a lower earnings limit. Earnings below this level do not attract your stamp towards your state pension. So really you want to make sure that you pay yourself more than this amount. Then you've got the primary threshold. Now, a year, maybe 2 years ago, the government decided to align the primary threshold with the personal tax allowance in order to take the pressure and the tax burden off employees, and especially employees who were not earning a substantial amount. So the primary threshold aligned with the personal allowance is currently 12,570. So I'll come back to that in a moment. It's only earnings over 12,570 that will attract employees' national insurance contributions. So then we've got the secondary threshold. Now, as you can imagine, the secondary threshold used to be higher than the primary threshold, but now it's all a wee bit backwards, because the secondary threshold is the threshold at which salaries attract employers' national insurance. So that secondary threshold is currently at £9,100 per annum. Then finally, we've got the upper earnings limit. So that's the upper earnings limit, and that is £50,270 per annum. So those are ones you need to be aware of. So salary nowadays, get another colour of pen. So I said at the primary threshold, earnings above 12,570 is where income tax hits, income tax being 20% at that level. And it's also where you start to attract employees' national insurance. So that is at 12%. So employees' national insurance contributions are charged at 12% on all earnings over 12,570 up to the upper earnings limit, where that reduces to 2% on earnings over the £50,270. Income tax is charged at 20% here, so your effective tax charge in that area is 32%. However, as you're the director, sole director of a limited company, effectively you're also liable to the employer's national insurance contribution charges, which come in at more than £9,100 per annum, and those are at 13.8%. So, and I suppose, sorry, this is where the 40% income tax rate comes in. So, what we recommend at the moment is that you pay yourself a salary right up to this personal or primary threshold, your personal allowance, you take all of that in salary. And that's because this full 12,570 is deductible for corporation tax relief. Now you'll remember that corporation tax is currently charged at 19 to 25% on all profits. So as long as you don't pay yourself more than this 12,570, there is a tax charge to the company, effectively a tax charge to you, but a tax charge to the company of 13.8% on the amount between 9,100, that secondary threshold, and 12,570, the primary threshold. And that works out at about 478 to 480 pounds, thereabouts of tax. So you're paying 13.8% on a little over 3,000, so a little under 3,500, you're paying 13.8% versus the saving of between 19 and 25% on the full 12,570. So hopefully you're still with me. Now, the other reason to pay yourself a certain amount of salary is because on any salary that you take above this 6,396, you get the stamp towards your state pension, in case I haven't said that already. Okay, so then what? Well, now, if you started to pay yourself more than this 12,570, income tax kicks in. You've got the employer's national insurance contribution and you've got the employee's national insurance contribution. So it becomes 20, 32, 45.8% tax that you'd pay on that entire income versus the saving of between 19 and 25% corporation tax. Make sense? Okay, so then we've got dividends. So dividend tax, you have, first and foremost, you have a dividend allowance. So the dividend allowance, whenever the dividend allowance was first introduced, it was £5,000 per shareholder per annum. It then got reduced to £2,000 per shareholder per annum. But from April 2023, that has reduced again to only £1,000 per shareholder per annum before any dividend tax is due. And from next year, so from April 2024, that's going to halve again to only £500, but you might as well take advantage of it while it's there. So, got a dividend allowance, and that is at a whopping great, 0% tax. Why 0% tax? Why don't they just say it's tax-free? Well, I suppose because it's taxed at 0%, it is still taxed technically. So the legislation doesn't need to be amended in order for them to increase that tax, if that makes sense. So that's the tax-free amount. So you've had your 12,570 in salary, then you get £1,000 of your dividend allowance in which you pay no dividend tax. But remember, it has to come out of profits after tax being paid. So distributable net profits, we'll call them for the remainder of this video. So that means that you will have paid somewhere between 19 and 25% corporation tax, but there's no personal tax to you. Then you've got the basic rate. Does it matter what colour I do? I'll try and stay the same for this. So you've got your basic rate of dividend tax. Let's call it basic rate dividend tax. And that is currently 8.75% on the rest of your earnings up to this upper earnings level. Okay, so you've got about 36,000 there that you can take, and you only pay 8.75%. So again, let's do the maths. 8.75%, even if you're paying the highest rate of corporation tax at 25%, that is 33.75% tax in total versus 45.8% tax in total. So it may be that you want to work your remuneration to stay within that basic rate band of tax. Because once you go over the basic rate band of tax, this 40% income tax level actually, this is income tax, but dividend tax at the higher rate dividend tax. So again, that's over 50,200, and where it's 40% here, it is 33.75% for dividends. So it starts to add up, because once you get to the 40% tax paid here, well, you're going to be into the higher rate corporation tax thresholds. So you pay 40% income tax, you pay the 13.8% employers' national insurance contributions, but the employees' national insurance contributions reduced down to 2%, and you're saving 25% corporation tax. That makes sense? Once you start spreading the two around, it becomes really complex. But the other thing that you can do, if you do not need to go up to that £100,000 of income level, you can start separating the company wealth from the personal wealth by making pension contributions. And I'll talk about pension contributions in the next video. But hopefully that mess of numbers there is enough to help you understand why we suggest you take a low salary of £12,570 per annum, depending on your situation, of course. Then you utilise your dividend allowance and you maximise your basic rate tax band in dividends, so long as you have got enough distributable net profit to do that. Any questions, as ever, pop them in the comments. I'll be really, really happy to answer. Thanks ever so much, and bye for now.